Hey, Darren Hunter here, Mortgage Right, talking a little bit about rates, inflation, real estate, recession, the bubble. There's a lot of discussion out there in the media, a lot of discussions on the social media platforms. But really, there's not a whole lot of data that's being talked about, especially on the social media platforms. And I'm not going to sit here and tell you I'm 100% right. All I'm giving you is the research that I've done, the statistics that I've done. There's always two sides to every argument, and time will tell, who's on the right side of this. But I certainly believe wholeheartedly and very strongly in my arguments and the statistics that I have that where I stand. I think it'll be very clear as you listen to my presentation about this. So let's take a look. So inflation is the big one right now, the big buzzword. Inflation is bad for rates. Our consumer price index, or CPI, is up over 8%. And if you watch anything that I've done over the last several years, the arch enemy of interest rates is inflation. And, that's because mortgage-backed holders, bond holders, they receive a fixed payment for a finite period of time. And as inflation erodes that buying power, the only way to combat that or offset that is to increase interest rates. So that's inflation. We anticipate the Fed will hike for quite a bit through 2022. I truly believe that for the most part, the market has digested that, and we've already really seen those increase in rates, but we're going to talk a little bit more about that. And counterintuitively, the hike is not necessarily bad for mortgage rates. When inflation slows down due to the hike in Fed funds rate, the reason they're hiking the Fed fund rate is to slow down economic activity, and mortgage rates respond favorably to that decline. But we're also dealing with the balance sheet runoff, and the Fed has amassed, over $9 trillion of mortgage-backed securities and treasuries, which they're getting ready to run off. And as they mature and collect principal payments, instead of reinvesting those and buying more mortgage-backed securities and treasuries, they're going to allow a portion of those to run off and reduce their holdings, which means, ultimately they're going to be a seller of mortgage-backed securities and treasuries. And that means much less, significantly less buying of mortgage-backed securities. And then, of course, the last buzzword that we're hearing about a lot is the recession. There's definitely talks, a lot of indicators out there that late 2022, early 2023, that there is a recession on the horizon. So what does that mean for rates and housing? So let's take a quick look. So let's talk a little bit about the history of the Fed and see if we can't find a pattern. Inflation goes up, mortgage interest rates go up, Fed increases the Fed fund rate, inflation drops, mortgage rates drop, but consequently we have a drop in the equity markets. S&P was down 30%, and this was back in the 70s and 80s. And then, of course, it was followed by a recession. We've got Alan Greenspan, inflation's on the rise, mortgage rates on the rise due to inflation. He increases the Fed funds rate, and the response to inflation is a drop of 2.5% and then a 3% drop in mortgage rates. But again, consequence, 50% reduction or decrease rather in the S&P, followed by a recession. So certainly a pattern there, hiking rates, slowing the economy enough to kill inflation, mortgage rates decline, again, pattern. But again, part of the pattern is stock market drop and an almost unavoidable recession. So now we have Jerome Powell in office. There's talks of increasing the Fed funds rate up to 3%. We're like we mentioned, the CPI is up over 8%, 8.5% plus. Mortgage rates are really more than 5% actually today. We're actually closer to 5.5, almost 6% on mortgage interest rates. And so what should take place is, as these Fed funds rates take hold, we should see a drop in inflation, which should be favorable for interest rates, mortgage interest rates. However, as we're already seeing, The stock market doesn't necessarily like the economy slowing down. And then, of course, there is a possibility of a recession that's on the horizon by some of the indicators I'll show here following this slide. So, we've been in a 14-year bull market. Is there a bear market on the horizon? I don't know. Let's see. So this particular graph and chart is very similar to what we're dealing with right now. This is the last time we were in a hiking rate situation and the runoff of the balance sheet, 2015. We hike rates, drop, hike, rate hikes, drop, rate hike, drop, rate hike, drop. And then we start to see, or there's a discussion about running off the balance sheet. And just a mere discussion of running off the balance sheet sends mortgage interest rates on the rise, and then of course they run off even more at a quicker pace, and just overwhelmed any hikes that have taken place to help with mortgage interest rates, to help with slowing down the economic activity. But as that sort of is absorbed into the market, you see the hike, a little bit of a drop in mortgage interest rate, hike, a little bit of a drop, and finally, 1, 2, 3, 4, 5, 6, 7, 8 hikes. And on the 9th hike, right prior to that, really, we start seeing a pretty significant drop in mortgage interest rates. And then it really, when they start discussing that they're going to stop or slow down the runoffs, and then they stop, it just really cascades all the way down. Of course, then we've been choppy, really ever since. So very constructive, in my opinion, to learn about and to take a look at what history is. And although interest rates are definitely elevated right now, the future, I think, is very bright. And once we get past the hiking of the Fed funds rate and past the runoff, mortgage rates are in a great spot, will be in a great spot, and so will the housing market. So this graph and this table is talking about or showing you about the inversion of the 10 and 2-year yield, and really what's taken place over this past year. You can see the yield curve is the 10-year minus the 2-year, and when we see that the 2-year is actually higher than the 10-year, that's very abnormal. The longer you tie up your money, the more risk you're taking, the greater you should be rewarded, right? Because that's how we're rewarded. The longer term risk, longer terms, greater risk, more reward. That's the way it should work. Well, in the past, when we've seen an inverted yield curve, where that means the 10 is actually higher than the 2-year, is higher than the 10-year, it's been a great indicator of a recession, and a lot of folks are indicating or talking about a recession in the wings. So we talked about the inversion. Do we agree with that? It's been a pretty reliable indicator. 70s, 80s, 90s. Anytime the yield curve has been inverted, it's led to a recession, inversion, recession, inversion, recession, inversion, et cetera, all the way to the late 2020, essentially. Right before COVID, we had an inversion, and then we had a recession. So although history does not always repeat itself, it definitely tends to rhyme, right? So what does this mean? If we have a recession, are there other indicators that we should watch out for? Certainly. One of the most reliable indicators is unemployment rate. As unemployment rate reaches its lowest level, then rises, it becomes a great indicator. Every time with 100% accuracy, the unemployment rate has been at its lowest and then turns high. We have had a recession. You can see this is going back 70 years. Low, turns up, recession, low, turns up, recession. And here we are all the way, fast forward all the way to 2022. We're certainly getting close to our lower lows. The unemployment rate has not ticked up at this point, but it's something we're definitely keeping a very close eye on. And if it does tick up, again, with 100% accuracy, unemployment increasing off the lows, does indicate a recession is on the horizon. All right, so what does this mean when we have a recession? Is it a bad thing if we get one at the end of the year or next year? As far as mortgage rates, we see a drop every single recession. I mean, take a look. By quite a bit, actually. I mean, you look from 16 down to a little lower than 12% in the 80s, 18 down to 13%, 11 to 8 and 3/4, etc. Every single time we've had a recession, we've seen a pretty significant drop in interest rates. So, is recession, is it bad for real estate? I mean, you would think so, right? So as we look at historical, real estate prices through Case-Shiller, the 60s, the 70s, the 80s, the 90s, the early 2000s, every time there was a recession, prices did well. In fact, went up quite a bit after the fact. Even in the early 2000s, right? You saw a recession, prices increase. And then, of course, the one anomaly was the housing bubble that everybody likes to compare this market to. And I would argue it's different when you have zero down, fog up mirror loans, when you're doing no income, no asset, no job, poor credit score. And not only are you getting one mortgage, you're getting multiple mortgages for multiple homes. The housing bubble was overcooked, and that led us into a recession. It was not the other way around. The recession did not cause the prices to decline. The bubble is actually what caused that. And you can see after finding our footing, prices have gone up quite a bit. In the last recession, true to form of the previous recessions, with the exception of the one time, you see prices increasing through the recession and continuing to increase. So I believe, the housing market is much stronger than in 2007. I mean, obviously the big macro statistic is the inventory. Let's, take a look. In 2007, at the peak, there was 3.7 million homes for sale. Now there's less than a million. Lots of less in inventory, but households have continued to grow since then. I mean, take a look at this graph. In 2007 till 2021, there were over 14 million more households fighting for 3 million fewer homes. Listen, although we have a period to contend with higher interest rates, I really believe that the future is very, very bright. In the housing industry, in the real estate industry, in the mortgage industry, there's plenty of opportunity. If you're looking to create wealth, it continues to be a phenomenal place to park your money. It's actually another discussion for another time is how do you combat inflation? And housing is one great way to combat inflation. So if you want to discuss more, please let me know. My name is Darren Hunter. I'm with Mortgage Right. I'm in downtown Woodstock. Happy to help. I'm licensed in 27 states. And hope you have a great day. Thanks so much for listening.